Hawaii's property insurance market is facing several challenges, reshaping the risk for homeowners, buyers, and the real estate industry across the islands. Condo insurance premiums have quadrupled for some buildings, while others remain underinsured, resulting in a pileup of unsold units and a falling of values. And now the single family homes are also facing their own challenges. But there is light at the end of the tunnel. To unpack both the challenges and the potential solutions, Anders Hostelli, regional manager from Rate Mortgage, will join us in just a few minutes. But we're going to begin with the undisputed world heavyweight champ of Hawaii real estate, the president of Insurance Associates, one and only Sue Savio. Sue, thank you very much for making time to be here today.
And thank you for having me. Quite an introduction.
I wanted to add it to your many other monikers: Oracle, Guru, Sensei, Sifu. But yes, also the heavyweight champion. So, Sue, today we're going to talk about several topics, including buildings with deferred maintenance. We're going to talk about underinsured buildings, the effects that are now taking place for the single family market. We're going to touch on fire safety regulations. And then finally, the good news with Act 296 and the release of the Hawaii Hurricane Relief Fund. But Sue, let's start from a macro level. Can you explain why insurance rates have gone up in general across the state over the past few years?
Okay, so the thing that created the problem was the Lahaina fire. Because if you go back, we haven't had a rate increase like we had this bill in 2023 and 24 until Iniki hit. Since Iniki, everything's been fine. We have our small little rate increases because obviously what happens in America, which we are a part of, we get zinged for a few little points every now and then when California has issues or Florida, but we don't get really beaten over the head like we did when Lahaina hit or when Iniki hit. So what happened? Lahaina's fires, even though we're a hurricane state and we are hurricane rated, it's the same reinsurers, the same insurance companies who pay for fire here or in California who charge the rate. So because it was our state that had a huge loss, a $3.6 billion loss, our rates skyrocketed. We thought maybe 100% at first, and it turned out to be for wood frame anywhere from 300% to 500%. And then for our concrete condos, it was anywhere from 100 to 200%. Now, condos budget the year before in August and September, and sometimes this year it's been June and July. We don't know if we're going to get through this hurricane season. Thank you, Kiko, for going away. But we need to make sure that if it stays down, where we're going to be. And so we're budgeting, assuming we're going to have another quiet hurricane season. And because 2024 was quiet, we started to see our prices go down, which is a good sign. But still, the 300 to 500% increase, or the 100 to 200, created a huge financial burden on condominiums and unit owners. And of course, the boards were panicking. And so that's why we have the issues that we have with unsold units, because they're not fully insured and people very upset about the assessments and borrowing from the reserves to pay the premium.
Right. Okay. And then let's talk about a subject that's it's sort of related, which are the buildings with deferred maintenance. And I've heard you say in the past, 90% of our condo stock was built before 1990, with a big part of that built in the 50s, 60s, and 70s. The first time I heard about this problem was from you about a year ago. Can you tell me or tell everyone what's happening and what the effects have been on the insurance coverage?
Okay. The biggest concern to the insurance company is that they're insuring something that is being taken care of. Because if you don't take care of it, you're going to have water claims, you're going to have problems. So when you figure 803 of our condos, and now some of them were apartment buildings before they were converted to condos, because we didn't have condos in the 50s. Condos started in 1965 and forward. But we have buildings that were built in the 50s and 60s and that are now condos that were converted. And then we have, of course, new ones that were built. But anything before 1992, 803 of them do not have sprinklers. Imagine how old their pipes are. So the insurance company got very concerned, not only with the Marco Polo fire on a non-sprinkler building causing deaths. When the Florida condo collapsed, insurance companies went hysterical because they could not believe that owners would not maintain their building. Now, that Florida condo collapsed mainly because of spalling. They did not do their spalling that they knew was bad 15 years before it fell. And they had an engineer's report. And the board was going to go out and assess everybody. And I would have been so proud to have been on that first board because they were going to take care of it. But they got overthrown. And the next board came on and didn't do anything about it for 15 years and started to do something, but the building fell. So the insurance companies assumed we're just like Florida. We got wind, sand, ocean, and condos. You must be like Florida and not taking care of your buildings. So all of a sudden, we had to start asking people, what have you done in the last 10 years to your building? And when you say nothing, you say, we haven't done anything, Sue. Oh, we don't have spalling. Okay, do you not? Or if you can tell me, we have spalling, we painted our building, we did the parking garage, we replaced pipes. That's what they wanted to see. So condos that don't do anything are very hard to insure, just like homes that don't maintain. So maintenance is very huge with the insurance company. So and you can all see it, when you go down the alleyway, you can see the buildings that are maintained and those that aren't. It's that simple. Or you go into a residential neighborhood and some homes look like they must nobody be living in them, but they are. So
Yes.
that's the same idea. Take care.
And Sue, for the condo buildings, you touched on piping. I'm assuming that's a huge one. Wastewater and water lines in the buildings. What are some of the other big maintenance issues that insurance companies are looking for?
Okay, so they're looking to make sure that you're taking care of your roof. Have you ever been up in your roof in the 50 years that your condos have been there? Do you have a roofer? Does he inspect it? Now, there are condos that have an actual contract with the roofers that go up once a year and take care of it. That's what they're looking for. Have you ever had your electrical inspected? Do you have the old federal system that causes fire? If you do, you've got to replace it. So plumbing, electrical, and roof, those are the big ones. And of course, with plumbing, it's the age of the pipes. They don't last forever in Hawaii, probably 25 to 30 years. And we have buildings that are 50, 60, 70 years old, and they haven't done their pipes. And of course, they have a lot of water claims. And then because of the Marco Polo fire, sprinklers. So I'm telling all my condos, you've got old, ugly pipes. It's time to replace your pipes and your sprinklers. There's a condo on the LOI, and I'm very proud of them, called 250 Ohua. They were just going to replace their 56-year-old pipes, but we convinced them to replace the sprinkler system at the same time. And just last month, everything is done. New pipes, sprinkler system. They're now up to snuff. They're good for the next 45 years. I mean,
I'll shout out to 250 Ohua. Good for them.
Shout out to 250 Ohua. And because they did the two together, it was cheaper than doing one pipes now and 10 years from now, busting down the same walls and putting in sprinklers. They saved about 40%.
That's wonderful. And Sue, are there financing options? Government, I think there was the C-PACER loans at one point. What's available for associations that want to go out and make some of these capital improvements?
Okay, there is the C-PACER, but it's part of the HHRF bill that was passed. But they're now opening it up for condos for maintenance issues, whereas before it was only for solar or things for the environment. But because of the issues and the expense that condos are facing, it's now opened up for elevator maintenance, upgrading, spalling, not everyday things, but pipes, sprinklers. And you can get a loan. It's for up to 20 million, and it's for 30 years. It's fixed, and they're not ready to loan yet. But there'll probably be another 8 to 9 months before they actually have the money to loan. But that is now open to condominiums. And of course, there's always the standard banks too.
Okay, great. Thank you for that. Sue, let's shift our attention to perhaps our key issue today, which is the underinsured buildings. And we're going to bring in Anders Hostelli, Regional Manager for Rate Mortgage. Are you there, Anders? Hi, Anders. How are you? And just to give this some context, there's a reported 400 to 500 condos on the so-called blacklist, lenders blacklist, that they will not lend. And if we look at what's happening in the condo market, there are twice as many condos on the market today as there were 2 years ago. Prices have been flat for 3 years or retracing in the various buildings. So it is definitely a big issue. And Sue, let's start with you. Can you describe what does it mean to be underinsured?
Okay, to be underinsured means you are not at 100%. And our bylaws and our condo statutes require you to insure to 100% value. And of course, the big issue, Fannie and Freddie will not loan unless you are at 100%. But when the prices of insurance went so high, people cut back because they couldn't pay the 300 to 500% necessary to buy the hurricane. So they were taking sub-limits because we hadn't had a hurricane for 33 years. So the main concern was water claims and a fire, not the hurricane. So that's where they felt that they could save money on.
Right. Okay. And then Anders, this was not an issue 4 years ago. No one asked, nobody talked about it. It wasn't a thing. What changed, and what does it mean if you cannot get financing through Fannie Mae and Freddie Mac?
So if there's a hurricane sublimit, even the banks won't touch those. So there's a couple what we call non-QM lenders that will lend in those projects, but the interest rate is of almost 1.5% higher. Plus the terms aren't as good, and you have to put as a buyer a much larger down payment.
I
So
see.
I mean, do you want me to give you an example of a
It'd
price,
be great. Yeah, let's look at some actual numbers. What would that look like? The
so,
difference of a building that has full insurance versus an
so
underinsured.
So I was just kind of doing some calculation. Today, a 0 point vanilla loan, borrower puts 25% down, 6%, 0 points. So if you have it, but if it's an underinsured condo, just because of that reason that we can't do saleable financing Fannie Mae or Freddie Mac, the rate's going to be about 7.5%, about a point and a half higher. And on a $750,000 loan, that's almost like $1,000 difference in the payment right there on a
Right.
monthly basis. Yes.
That's substantial. That is substantial. And the buildings where we
Mhm.
see retracement in values generally have been the underinsured. Those are the
Mhm.
ones that are really, really feeling it. And Anders, what about VA and FHA loans? Will they touch anything that is
Yeah.
underinsured?
Good question. FHA will not. VA is not as specific on the requirements for hurricane. It does require 100% replacement, but that's typically like what we look at for hazard like a replacement. So VA will allow us to do projects where there is a hurricane sublimit. So that
Okay.
is eligible, yes.
And
Mhm.
Sue, we're going to pull up an example of an insurance summary in a moment, but I know there's one other issue here, which is I look at my insurance summary, it is 100% coverage, but there's an issue with the deductibles. Can you explain what the issue is with the deductibles to still be able to be in conforming?
Okay. Fannie and Freddie will not accept anything more than a 5% deductible. When you have, and because condos have such aging pipes and have so many water claims, the insurance companies went from an occurrence deductible saying that 10 units got damaged, that's one occurrence, and there's one deductible. They went to a per unit deductible. So if everybody has a $25,000 per unit deductible, when Fannie multiplies that by the number of units, it's over 5%. So what we have to do is cap it, and that's what we do. So the insurance companies understand that they can't go more than five. But the idea being, for example, I had a high rise with a sprinkler on the 41st floor broke. And of course, it goes all the way down to the lobby. But we had a per unit deductible. So we only paid on 3 units. And the way the per unit deductible works for the common element is all the common element is one deductible. So the association got the money minus 25,000 for the common elements. And most of those owners had to go to their HO6 policy because it was 7,000, 10,000, 20,000. Only the one right below, the 2 units right below the original sprinkler got above 25,000. So it makes a huge difference to the insurance companies because they're not covering all these water claims, which is not their main goal in life. Their goal is to cover catastrophic events, fire, lightning, windstorm, things of that sort. And they hate these maintenance issues because we don't maintain things. So that's made a big difference in our availability to get coverage and to keep our deductibles lower, but it is per unit and we have to cap it. So then we can get by if we cap it.
So it is capped, and then the homeowner's HO6 is the one that will pick up the additional or that initial
Right.
money. Okay. And there's anything you want to add to that on the deductibles?
Those are the guidelines, Fannie Mae and Freddie Mac. There are some portfolio lenders. We even have some that will go to a higher deductible, even up to 10%. But for saleable loans, like Sue, I mean, I've actually reached out to you on several occasions asking you if there's a cap policy in place that caps the amount of the deductible to keep it under that 5%. So
Yeah.
yeah, it's very important.
And I remember last year when we did this webinar together, it seemed like the cap was a fairly new thing. Was that the case?
It is
Yeah.
relatively in the capping. Yeah.
Yeah, I see, but it's become kind of commonplace. All right, Sue, let me pull up a sample of what a buyer or a realtor might see for the
Okay.
insurance summary. And wondering if you could walk us through here, what is it that we should be looking for to make sure that the building is fully insured?
Okay, so the main area is, of course, the commercial property, and everybody puts the property first because that's the biggest expense 99% of the time. And you will see that it will say building replacement cost, and it shows you what the total value, replacement value, not real estate, the total replacement value is. And this building is 102 million. Okay, then you're going to see that we include business personal property because for an association, there's always a lobby and there's maybe a manager's office, so it's included. And then you'll see that you'll go on to different things, equipment, covering the equipment, etc. Then you have building ordinance. Mortgage companies are very concerned about building ordinance, and we always have that in our summaries. So then some policies don't cover sprinkler leakage, and that's important to have it if you have sprinklers. And this building does, so we showed it in our summary. And then when you go down, you'll see something called the hurricane limit of insurance per loss event. The maximum they have for any one hurricane is 10 million. They really need to have to be fully insured 102,300,000 per the value of the building. Because it's a sub-limit, it is not fully insured. It's not acceptable to Fannie and Freddie. You're going to have the problems of a higher mortgage interest rate and a higher payment. So this is not one that would be an easy sell for a mortgage company or for a realtor to sell. But
I see.
So that's what you're looking for. Then you're going to see your deductibles. It's very important to know what your deductibles are because your deductibles tell you what you as a unit owner need to insure for. And this one has a deductible of water damage per claim, per unit rather, of 25,000. But if we have a fire or if a car creams through the lobby or anything else goes wrong, our deductible is only the 10,000. So even though the fire may do damage for 5 units, it's 10,000 for the occurrence. It's not per unit. Only water, because we have so many water claims, that it is at 25,000. There's a condo in town that is on their 98th water claim, and they were built in 2020.
Oh, no.
Yes,
Oh, no.
not one that built in the 50s, one in 2020. Okay,
And they can
so
still
it
get
happens.
coverage.
Yeah. So that's why the per unit came out.
Okay. Okay, great. I think maybe we lost Anders, but let's shift over to talk a little bit about what's happening in the
Yeah, I'm
single.
back.
Oh, there you are.
Sorry.
Okay.
Okay, sorry.
Disappeared there for a minute. Sue,
Yep.
can you just talk a little bit about what's happening in the single family property market? I've been hearing rumors of rising rates and non-renewal policies, but I know you'll know exactly what's happening.
Oh, yes. Okay. So condo rates went up in 2024 because of the Lahaina fires. Insurance companies who write homeowners policies in our state have to get their rates approved by our insurance commissioner. So they had to submit their losses. And so in 2025, or the end of 24 and beginning of 2025, rates went up on the homeowners policies anywhere from 20 to 70%.
Hi, it's Patrick. If you enjoyed this information from Sue Savio and Anders Hostelli, please do give us a thumbs up down below and be sure to subscribe.
So and of course, if your home is in disrepair and not a new roof or not a roof within 15, 20 years. So all of a sudden, homeowners are where condos were the year before. But condos are coming down, homeowners are going up because they had to go and get their rates approved by the insurance commissioner, which takes time. So they couldn't do it in 24 like the condos did. They had to do it in 25. They got it approved. So what's happened is now we have carriers saying, I'm not going to write HO6s, they're leaving our state, or they're not writing HO6 policies. We have other carriers that are saying, I'm not going to write a home unless the roof is 20 years or younger. Others are saying, if your pipes are old, I'm not going to write you. Others are saying single wall, we're not going to take you. But yet, if you're single wall and you have a decent roof that has a good 15 years left and you've done some plumbing and some electrical upgrading, they'll take you. So it's finding the right niche for what you have. The biggest problem, just like with the condos, is those who have done no maintenance. My home was built in 1953. I haven't done a darn thing to it. Grandma and Grandpa paid $20,000 for it. It's worth much of nothing. They think in their mind, not really, and it's worth $1 million, and they should be taking care of it. So they don't have an old roof. They've never done electrical upgrades. They've never done any plumbing. Insurance company doesn't want it because it's going to be a problem. They're going to have a fire or a big, huge claim, and when the hurricane comes, of course, it's the first one that's going to be gone because you don't have clipping or anything of that sort. So yes, the homeowners, the single family homeowners market is where the condos were the prior year. And it is very stressful for homeowners.
Very interesting. And Anders, how about from your perspective? Are lenders asking to see any of those items on homes so far?
Is no, I mean, but we of course require insurance and acceptable insurance, and I do hear stories of insurance isn't as easy to get, or the premiums. We've been doing some loans on the Big Island, and all of a sudden the premium is much more expensive than what was expected or even had been in place from the previous owner.
Yeah, very interesting. Such interesting times. And Sue, what about oceanfront single family homes?
Oceanfront single-family homes, if maintained, are not a problem. But many
No.
insurance companies will write oceanfront, but you do have to have it maintained. You can't, anything that is old is a problem, whether it's oceanfront or not. Okay, so that's the biggest concern. But oceanfront, and usually, I mean, take Kahal Avenue. There's not a problem insuring any of those homes, but you've got a home that, or Port Lock on the ocean, any of those that are on the ocean, Colonial Highway, as long as they're well maintained, they're insurable.
Okay. All right, great. And there's anything else you want to add to that?
No, I think I'm good. I
Okay,
appreciate it.
good.
Thanks for having me.
We're going to take a quick break and then we come back more with Sue Savio. We're going to talk about the fire safety regulations and then also the good news of Act 296 and the reopening of the Hawaii Hurricane Relief Fund. So stand by. We'll be right back with Sue Savio. Okay, and we're back with Sue Savio. We're talking insurance, but we're going to switch to fire safety ordinance in Honolulu, Hawaii. To sprinkler or to not to sprinkler? That is the question. Sue, can you talk about this issue? And I know there's both the fire safety regulation, but more importantly, the insurance component of this. Can you talk a little bit about that?
I sure can, because everywhere I go, I stress the need to put sprinklers in. I don't care that you pass the LSC. I don't care that you don't have to do it because you're only 3 stories, 5 stories, you have open stairwells, or whatever the case may be. I keep on stressing to people, the city and county or the fire department or our legislature may not require it, but at some point in time, the insurance industry is going to say for a high rise, you don't have sprinklers, we're not going to insure you, because the risk is so great to them. It's not so much the property damage, it's the loss of life. And only water coming out of that sprinkler puts out the fire. And we would not have had lost those 4 lives at Marco Polo if we had sprinklers. Of course, they have sprinklers now, so of course they're insured. But what's going to happen, and granted, we don't have to have sprinklers. Many of us are, the 803 of us before 1992 are all grandfathered in. But if they change the rules, which they will someday, maybe not in my lifetime, I tell people, but it will become required someday. We happen to be on 2018 building codes. And when we go to 2020 building codes, which the rest of America is on, they do state 3 stories, residential, 3 stories and above has to have sprinklers. And we will be building to that code someday in the future. But the problem is there's so many of our old buildings that aren't, and it is terribly expensive to put in. But at some point in time, and I think that's why even now with the reserve studies that have come out, they're 30-year reserve studies, and they allow you, which a reserve study normally doesn't do, to save money in your reserves for sprinklers because they know it's going to be required. And they're giving you 30 years to do it because I'm pretty sure at the end of that 30-year term, they're going to expect you to have the money to put sprinklers. And I'm sure at some point it will become mandatory, or else the insurance companies will not write high-rise condos. And we only have 4 carriers that write high-rise condos in our state that are standard markets that are housed here. And of course, State Farm hasn't written a condo since Iniki. And the other 3 are keeping what they have as non-sprinklered. But as those buildings have a fire, they are telling me, are you going to sprinkle? Are you going to put sprinklers in? And if you say no, then they're going to say, well, we're out of here. But they'll hang with you. If you say yes, they'll hang with you while it took Marco Polo 4 years to put their sprinklers in. They'll hang with you at the standard rate until that time. So it behooves all condo unit owners to make sure their boards have a reserve study where they're putting money aside, even if it just pays to have the engineer's report done at some point in time for sprinklers, because we're going to have to do it. It's just a matter of time.
Okay. And Sue, I know you see a lot of the AOAOs and what they're doing. Do you have a ballpark or a range what it costs per unit putting in sprinklers in some of the old buildings or some of the ones you're involved with?
I would say probably anywhere from $20,000 to $30,000 as an assessment that you get a loan for. Or I know at Contessa it's a $50,000 assessment, and they're go get your loan because we're going to do this style. So it varies by the configuration of your building, how they're going to do the pipes, where there's a lot that goes into it but I've never seen anything less than 15,000. So
Okay.
and all the way up to 50. So it's hard to say. You literally have to have that study done, and they'll tell you how much it is. But as I tell everybody, the reason you want to vote for it, even though you're saying, well, I'm an original owner, I'm old, it's not going to get done during my lifetime. I say, yes, but you're going to leave this unit to the next generation, or maybe the third generation, so that they can afford to stay and live in Hawaii if they choose. And are you going to really give them a unit that has to, maybe you're being assessed 30,000 and they'll have to be assessed 70, 50, 100,000 for a sprinkler, and you didn't take care of it during your lifetime? I mean, your grandchildren who get this unit are going to be thrilled until they have to take care of it, things that you don't do. So I'm trying to convince people, bite the bullet, do it now, get it done, start the process, so that no matter whether you live 10 years more or 20 years more, you've done a good job as being an owner and passing
Yes.
on your wealth.
And there are several states who have mandated it, and it's not an
Yes.
option. You have to do it. You have to go in and put it in. Thank you for that. Well, let's move on to some good news. The light at the end of the tunnel. So Act 296, which was signed, I think, back in July.
Right.
And now we have the reopening of the Hawaii the Hawaii Hurricane Relief Fund, HHRF. Can you
Right.
talk to this? And then we're going to show some examples of what the actual savings are. But can you explain what this is and how this is helping?
Okay, so the HHRF came into existence after Iniki, because what happened was, thanks to the real estate industry, they were pushing for something to get settled because there was no way to buy or sell anything because nobody was writing hurricane insurance out of state. So thanks to the realtors, they forced the legislators to come up with this Hawaii Hurricane Relief Fund. And basically, when everything got fine around 1992, so it went into dormant status, but it had money in it that just sort of sat there, and that was good. So what happened was, when Lahaina hit, and we had huge expensive insurance for hurricane, the legislature decided to reactivate the Hawaii Hurricane Relief Fund, and it got signed into law, as you said, July of this year, though it started to sell policies in June of this year. And there was a great savings because of it, because the study was done and the state went out and bought reinsurance. So it's not like the state's paying it out of pocket. They bought the money they had, they paid to have the study done, they paid to go buy some reinsurance, and then to get it working. So it's a good thing. It's done a lot of things to reduce the price so that people who were not at 100%, I had in 2023 and 24 about 375 buildings not at 100%. I am down now probably closer to 100 that don't.
Oh.
And I've got several more months of renewals this year. In fact, one today said, yes, we're going to buy 100% because of the reduced price of the Hawaii Hurricane Relief Fund. So it is a good thing that has happened.
Yes.
And go ahead.
Okay. Oh, sorry. I'm going to pull up an example here. We'll take a look at something that you put together. And can you kind of walk us through? This is the results of the HHRF.
Right. So there was this Mo'iliili condo that is insured for $50.4 million. Last year's quote for 100% hurricane was $116,299. This year, the insurance market, not counting HHF, reduced it to 103. So the prices were coming down anyway for the cost of hurricane this year, because 2024 was a quiet hurricane year. So this year, instead of having to pay 116, they were going to have to pay only 103. I say only 103, but it's still a chunk of change, right? So the HHRF, we sent to them to quote, they came in at $45,338. So instead of 103, it was $45,000. This condo did not have 100% last year because they couldn't afford the 116. When I showed them the quote for $45,338, they jumped at it and said, we'll go back and be compliant and have that 100%. So the standard market came back and said, we don't want to lose the coverage. We'll come down and match the HHRF. In fact, we'll do better, Sue. We'll let you have it for $37,475 because we know you're going to give us plenty more, Sue. I said, I sure am. So they came in at $37,475. So, I mean, it was a huge savings. I mean, there's even, more money. So this condo could now be 100% insured, be able to buy and sell, refinance. I think this was the condo where a man called me, was trying to refinance to put his kids through college. So I think he's the one that called me after, and he said, okay, now that I've got 100%, I can do it, Sue, because he called earlier and I said, I can't, they don't have 100%. You can't borrow. But so
Right.
it's a good story. It was wonderful.
Oh, that's great. So this is an example of HHRF influencing the private carriers to actually come
Right.
down. And let's take a look at the next one. Now, this is a Waikiki condo. Can you walk us through this one?
Sure. This is a Waikiki condo at 69.8 million. The secondary market quote for the hurricane was 159,000. The HHR quote was 85,000. The standard market was not willing to come down, which is fine. So they did go ahead and purchase the HHRF quote, and also now are 100% insured. So the HHRF here, we bought the policy from them, and that was fine.
That's great. Okay, one last example here. This one's a little more complicated. You can explain this one.
It is complicated, but it's a fun one. So this is a large Kapiolani condo, okay? Now we got to go back to 2023. The Lahaina fires hit. This is renewing after the Lahaina fires. So they want to spend the money and buy 100%. We could not find anybody willing to sell them the last 34 million to get they needed. Nobody. We tried the whole marketplace. Everybody said no, no, no. So they were underinsured for 1 year, 23 to 24, even though they were willing to pay for it. So 24, 25 comes. They paid $472,000 for 150 million excess of the standard 10. So their 150,000 million rather of premium of coverage cost them 472,000. So 25, 26 comes. So they're 100% at 2024. So now renewal comes in 25. The 200, they could get the 150 million. They needed 153 because the price had gone up a little bit of replacement cost. So they paid 212,000. They got a quote for 212,000 for 153 million excess of their 10. Okay. So again, the HHRF forced the industry. In fact, they did use HHRF. And so they saved $260,000 because the HHRF policy. That's money for people to spend in that complex on their own life, not on insurance. So Incredible. This was a nice one where, these are obviously people who had the money to pay for the hurricane, couldn't get it the first year, got it the second year, it's expensive, and now the third year, it's great. They're half campers.
Wonderful story. Okay, and then let's go to this last slide, which gives a little bit of a summary, if you can explain this.
Yeah, as of August of last month. Now, we had 20 policies ordered. We had 2 more, and we have more now, but we had 20 policies actually ordered and placed with the Hawaii Hurricane Relief Fund in 1 month. And we had 2 more we were working on, and we bound premium. In other words, the dollars we sent to the Hawaii Hurricane Relief Fund was about $800,000. Okay. With savings to the people is about $600,000. If we took the non-hurricane rate or the rate that was before the hurricane, convinced the insurance company to lower theirs, that was a $600,000 worth of money that would not be in our economy because it was going to the insurance companies. But we were able to save that $600,000 and made things so much easier and better for Hawaii because we now have money to take the kids to the zoo and buy dinner out or whatever the case may be, but live instead of paying it for insurance. So
Incredible.
It was a good time. Yeah.
That's a good time for sure. Glad to see those examples, and that's a good summary. Okay, so Sue, just to kind of wrap this up, what is your advice for these condo associations and for homeowners going forward?
I think the biggest thing is to ask yourself, are we maintaining our complex? Are we following our reserve study? For those of you in single family homes, how old is your roof? Have you ever had your electrical inspected? Have you ever had your pipes inspected? There's plumbers with cameras that put it down your pipe and tell you they're great, no problem. Isn't that nice to know? When you go to, for those of you with realtors, when you're going to sell a home that isn't pristine, ahead of time, I'm telling them, have the owner have a roofer go up and give you a roof inspection or an electrical inspection or a plumbing inspection. Because if you come to the insurance company, the new carrier that's going to take it on, if you say my home was built in the 60s or the 50s and you don't have that and your home doesn't look pristine, or even if it does look pristine, they're still going to ask you about your roof, your pipes, your electrical. So why not be prepared? Start off by you as a homeowner getting that done. I mean, had a very old friend pass away, and she left us in charge of her estate. But she forgot to pay her insurance because she was old and made a mistake. And so when we went to check on it, there was no insurance. And I'm trying to get this older home insured. I couldn't do it on the standard market because I had to get the roofer out there and all these other things. And so I finally had to go and spend, instead of spending maybe $1,000, $3,000 to insure it, but I needed to get it insured since I was in charge of the estate. And when the new people went to buy it, which they did, we sold it, I was able to give them the report that showed there is this roof. And so they were able to take this report, go to their insurance company and say, we're going to redo this, this, and this within the next 90 days. Here's the contractor that's going to do it. They had no problem getting insurance.
Oh, very interesting.
Yeah. So in other words, be prepared as realtors ahead of time saying, okay, this house has nothing been done for 50 years. It's not going to be an easy sell. Though it's a great lot, somebody can come in and remodel. It doesn't matter to the insurance company. So if you go ahead of time, the buyer or the seller pays for all this ahead of time, be prepared. And knowing that you're going to have to do certain things, you'll have no trouble. Even if it's single wall, you won't have issues. So that's right.
Great advice.
Nice to you all.
Yeah, great advice. Sue, thank you very, very much for sharing all your knowledge. For everybody that's watching, if you've enjoyed this, please give Sue a thumbs up down below. Be sure to subscribe. Sue, thank you very, very much on behalf of everyone in our real estate community. And for everybody that's watching, until next time, be well, be kind, and aloha.
Aloha. Thank you.
Thank you, Sue. Thank you very, very much. Really appreciate it.
More than welcome, dear.
I'll tell you how many thumbs up you get later on.
Okay. All right, dear.